Great, thanks, Dee. Yeah, welcome everybody. Thanks for taking the time to come out. I'm Katy. I'm an analyst here at REMI, and I'm joined by Haozheyi, Guan, an analyst here as well. She helped prepare this presentation and will be on the line for questions at the end. So we can go ahead and get started. First of all, I'd like to sort of pose these questions about what diversity, equity, and inclusion mean in the context of tax policy. So the first question related to diversity: how does tax policy affect different people differently? Who is affected? Equity, the question there would be, how are impacts distributed? And inclusion in tax policy refers to this question of everybody getting a fair shot at prosperity. So these three questions will guide us throughout our presentation today when thinking about DEI and tax policy. So the core question in tax policy is who pays? There are many different stakeholders in the economy. That means that there are multiple different, racial and ethnic groups, gender groups, geographic groups, and groups with varying levels of educational attainment. And each of these different categories also has linkages to wealth and income levels, which is where some of these tax questions tie in. So we want to know, do policies benefit all income levels? Does a tax increase or reduce income inequality? We want to know if a tax benefits all racial and ethnic groups. We also want to know if a tax is benefiting or disadvantaging those without higher education. And finally, we want to be sure that the tax system is getting everybody a fair shot at the American dream. So when we talk about DEI and tax policy, these are just a sample set of questions that we are interested in looking at. So some examples of taxes where different differential DEI considerations come into play are like a goods tax versus a services tax, a flat tax versus progressive tax, capital gains versus income tax, and of course tax expenditures are also a very political area of interest when it comes to tax policy. So later on, we will be looking at the DEI impacts of an excise tax and a tax credit in the demos, but these are just some samples to kind of illustrate why DEI matters in tax policy. So framing these different tax policy issues are these two competing economic narratives. Of course, public goods like infrastructure are popular. Everybody thinks infrastructure sounds good, but of course, how to pay and who pays are the more difficult questions that we struggle with in tax policy. So generally, Republicans oppose tax increases, Democrats oppose flat or regressive taxes. And sometimes there's that difficulty with public perception and gaining that support for increases in taxes or changes to a tax code. So there is an inherent tension between distribution of funding and return on investment, but to understand sort of the complexities of DEI and tax policy, despite these competing economic narratives, we can use economic modeling to bring some clarity to these difficult questions. So just to introduce ourselves as a company, if you're unfamiliar with us, we are Regional Economic Modeling Incorporated. We've been around for over 40 years now, and we're the leading public policy analysis model. We offer practical software solutions across a variety of policy topic areas, but most specifically when we're talking about tax, we offer Tax-PI, which is a solution that analyzes the dynamic economic and fiscal impacts of policy changes. The DEI extension, which we'll be looking at today, adds race and ethnicity, gender, education level, geography, and income distribution dimensions to policy analysis. Also, to be clear, we'll be using PI Plus with the DEI extension, so we'll call it the DEI model, although the DEI feature is applicable to the whole suite of models. But after that quick introduction of who REMI is, I'd like to answer the question of why care, why do economic modeling at all? So some good reasons are, one, to capture the direct and indirect effects of taxes. Two, to understand the economic and demographic impacts across industries and over time periods up to 2060. So not just, looking at these impacts and understanding them over, a short time horizon or only over the next 5 years. We're capable of doing that, but we are capable also of looking at these dynamic impacts much further into the future. Economic modeling can also help articulate costs, benefits, and trade-offs of policies and projects, which, as I've mentioned, and as I'm sure we all know, like policies and projects can be full of complications and varying competing interests. So being able to articulate what the benefits and the trade-offs are can be very valuable to your stakeholders. Also, to evaluate policy with standardized metrics before implementation to help guide better and more informed policy making. And again, to clarify these complicated policy situations. These are sort of the key reasons that economic modeling is valuable to policy analysis. So to get started with a more concrete example, we're going to talk today about the gas tax, which is an excise tax at the federal level, currently at 18.4 cents, or I think that was as of January of this year. Additionally, various states levy gas taxes that can take on sort of a variety of forms. So there are per gallon excise taxes at the pump, there are excise taxes imposed on wholesalers, and there are sales taxes that apply to the purchase of gasoline. And essentially, gas taxes serve as a stable revenue source to fund infrastructure maintenance and repair needs, sort of based on that idea of benefits that, who's using the infrastructure is paying for it. That's sort of the underlying concept. Here we have a map illustrating tax rates across the country at the state level, sort of showing that regional dimension that is present with a gas tax. And illustrating sort of these differences across the country. So looking in at Nebraska, this will be the state that we will be performing our model demos in. We chose this because the DOT in Nebraska ended up raising the gas tax in the state to support falling revenues during the pandemic. And this was a little bit of a nuance as part of a state law that this variable tax part of the state law gets triggered to keep the revenues in balance with the roads budget. So with the COVID pandemic, that fall in revenue triggered this raised gas tax. So it was in effect from July 2020 through the very beginning of this year. This graph, built from data from the Department of Revenue in Nebraska, shows this spike, again, clearly happening when COVID happened. That's when that trigger was pulled to raise the gas tax rates to fulfill that revenue gap. Again, just to reiterate, we aren't doing a real in-depth look at Nebraska specifically. We're using this, really using this as a simulation and just as an example. So I just want to be clear that we're not really capturing the full complexities of the gas tax in Nebraska, but rather using it as an example. So jumping into our first demonstration, we'll be looking at the effects of a gas tax increase and specifically the DEI implications of such an increase. So we're using a single region Nebraska state model. This is a DEI PI plus model. And the scenario that we will be modeling is this sample, this example that actually happened in Nebraska where the coronavirus raised that gas tax to a record high. The model inputs we're using will be an increase in the gas tax by $50 million over the time horizon of 2021 through 2030. This first demo, I'll take you through these screenshots so that we can more clearly see these effects. But then for our second demo, I will show you live in the software so that you can actually see what it looks like to work with REMI DEI. So sort of our big picture look here, this gas tax increase, as we've modeled it, shows pretty negative effects across all these different economic results, as you can see. But I think the key place we'll want to look is at the price index changes, where we see that that increase over our time horizon. So looking at this graph, we can see the change in price index by income quintile. So we have our all income groups shown in that lighter blue, and then each different bar represents a different quintile. So we see a lower raise in price index for the lowest 20%. We also see that being a rather low effect on the highest 20%, whereas these middle income levels from the second 20%, the middle 20%, and the fourth 20%, we see higher impacts on the price index as a result of this gas tax increase. So again, over the time horizon, we see that pretty consistently happening, where this price index effect is rising for our middle income quintiles and not so much for our lowest or our highest. This is a specific data feature in the DEI model that can help perform this type of analysis across the income distribution, so you can better understand how a policy is affecting different income groups differently. Here we see the same measure essentially, but broken up into more, I guess, more specific income groups. So we can see by yearly income, this change in the price index. So at a little bit more granularity than the previous graph. Looking at compensation by industry, of course, this gas tax, this is raising taxes without really seeing, you know, the benefits from that tax, just for the sake of simplicity. And again, we wanted to sort of isolate this price index effect for this demonstration. But looking at these other factors, which the REMI model captures, we can see these negative impacts of an increased tax, which would be expected. We see pretty high negative effects on the second lowest 20% and the lowest 20%. But again, this is kind of to be expected with that raise in an excise tax without anything to offset it. Looking at employment by industry, again, we see losses across all quintiles, especially for the lower quintiles. And looking at employment by demographics, so bringing in this DEI feature of looking at different racial and ethnic groups, we can see the loss in employment by demographic group broken up into white non-Hispanic, Black non-Hispanic, other non-Hispanic, and Hispanic. And as you can see in this graph, sort of the differential impacts on employment by demographics. So we see all groups suffering, you know, from this higher tax, but broken up by group, so that we can actually see, you know, how this policy is affecting different groups differently. Moving on to labor force participation rate by race. Here we can look at labor force participation broken up again along those same lines into white non-Hispanic, Black non-Hispanic, other non-Hispanic, and Hispanic categories. We see the biggest loss here to white non-Hispanic and Black non-Hispanic groups, but losses across the spectrum. This feature in DEI captures the type of jobs and the employment effects of the policy change that specifically involve educational attainment. So here we see a loss in jobs for both jobs that require a bachelor's degree and also jobs that do not require a bachelor's degree, but we do see the greatest loss in jobs for those with no bachelor's degree. And also within the model, we do have an ability to kind of look at this educational level at sort of a higher level of granularity. You know, if you're interested in seeing how this affected people or jobs that required associate's degrees or PhDs or some college but no degree, etc. So that is available. But looking bigger picture, we see that those without higher education are suffering more. Okay, so that was our first simulation. We saw those effects across income quintile on that price index, but now we're going to turn to a different scenario involving the gas tax and the earned income tax credit working together at the same time. So for background on the EITC, it's a benefit to help low to moderate income taxpayers. It's of course a federal credit, but also a state credit in 29 states, as well as DC and Puerto Rico. Over 25 million people received about $63 billion in federal EITC from 2019. So clearly this is a very big, very important tax expenditure program. So the EITC was proposed in the 1970s, enacted by Ford, so a Republican president, and expanded greatly under Reagan. And it initially had really broad bipartisan support, but those competing economic narratives had sort of come into play with the EITC as well. So it's been in discussions, especially surrounding controversy for wanting to scale back tax expenditures or eliminating those. So that's all sort of in the background, but the EITC in essence just reduces the income tax owed for those who qualify. It's progressive, it's a refundable credit, and it's based on these factors to, with the intention of assisting moderate to low income workers and boosting that family income. So it is intended to reduce poverty and income inequality. Using this tax credit, we are going to pair that with the gas tax in this second demo. Again, we will be using the single region Nebraska state model. And here we will be modeling an expanded earned income tax credit alongside a higher gas tax. So we increase gas tax by 50 million, decrease personal tax by 50 million. And we're looking at it over the time horizon of 2021 through 2030. So this will be a little bit more of a complex scenario and a revenue neutral scenario. So here I will go to REMI DEI so we can actually see that in action. Here is our interface. This is our home screen on our REMI PI Plus and our REMI DEI feature. This is where you start, so it's fairly intuitive. But I've already prepared our demo so that we can sort of jump right in and just get started there. So beginning with our key results, we can see increases in employment over our time horizon as a result of the increase in the gas tax offset with that increase in the EITC. We see an increase in population in the region. And again, this is a one region model, so we're still looking at the state of Nebraska. We see an increase in the labor force, an increase in GDP, increase in personal income, and general increases overall across this general economic summary table. Looking in now at our DEI indicators of interest, we will start by looking at the income distribution and our compensation rate changes. Apologies for the little bit of a lag on my shared screen. I hope that's not disruptive, but here we see the effects of this policy change on the income distribution here, well, on the compensation rate, specifically by income distribution. Then we can look at employment by industry, and we see here that the highest 20% is sort of taking the most negative effects from this change in policy. And we're seeing the highest effects going to the lowest 20%, as well as initially to the middle 20%, and then seeing some high increases over sort of this early part of the time horizon to the second lowest quintile as well. But altogether increases across the income distribution except for our highest income quintile. Again, this is sort of to be expected as the offset to the gas tax went to our lower income groups, as the EITC is designed specifically for those lower income groups. We can also look at compensation by industry, so and broken up by income quintile. So sort of similar to that employment graph, we can see those losses to the highest 20% and the gains to the other income quintiles of interest. Looking at these DEI components, we can see the breakdown of employment by demographic across our 4 racial and ethnic groups. We see the increases in employment across all of these groups. And this, again, this is race and gender. So we look at it by race broken out here, and we can look at it by gender broken out here, where we see sort of these dramatic or more dramatic differences in increases for female populations as opposed to male populations. And if we want to look at these side by side, we also have this capability to look at how employment by demographics changes depending on gender and race at the same time. Looking at employment by educational attainment, here we see a gain in jobs for those with a bachelor's degree. We see an increase also for those that require a bachelor's degree, but here I will take the opportunity to show the more detailed breakdown of educational attainment groups that the model is capable of. So depending on the type of questions you're trying to answer, you can see these different levels of educational attainment and the number of jobs created for those different levels. Looking at labor force participation, this is sort of similarly broken down as the employment by demographics tab was. We have a by race tab, a by gender tab, and a by race and gender tab. So here we can see the labor force participation rate increasing across all of our demographic groups. We see it increasing mostly for white non-Hispanic and Black non-Hispanic demographic groups, and still some increase for other non-Hispanic and Hispanic groups. By gender, we see more even participation rates broken up between male and female populations, and increases over our full time horizon. And also, just in case you want to see these results by both race and gender, this table captures these details together at once. Looking here at unemployment as a result of this gas tax, along with the EITC, see a small decrease in unemployment in the beginning, and then a small increase later on in the time horizon. And then here we see some increases in personal income per capita. So sort of to tie all that together, the gas tax with the EITC added, this scenario really showed increases and benefits to the lower income groups. As we expected with the EITC, we saw some negative impacts on the highest 20% and on the second to lowest 20%. And that's because here, I think is a good illustration of that. Here we see the loss of the second lowest 20%. And we see this because the benefits of the EITC increase are going to our lowest 20% and not benefiting the second 20% enough to offset the costs of that gas tax. So jumping back to our presentation, this was our revenue neutral scenario. And here, just to summarize both of those, again, to kind of highlight our key outcomes, our gas tax simulation illustrated negative effects on employment, compensation, labor force, population, output, and increased price indices across all income groups. But we were able to see in more detail the differential effects on price index depending on income quintile. Looking at the gas tax in combination with the EITC increase, we saw positive effects on employment, compensation, labor force, population, output, and an increase in price indices again, but we saw this decrease in compensation and employment by industry for the highest income group and small decreases for the second lowest quintile at the end of the time horizon. Again, that's because our second lowest quintile is really bearing the brunt of that gas tax while not seeing the benefits of the EITC. We saw those notable increases in employment for the female population and increases in employment across demographic groups. So these two demos, I hope, captured the ability of the REMI model and REMI DEI specifically, the ability that the model has to account for both DEI issues and these dynamic economic impacts. Especially when it comes to tax effects, we're interested in capturing the complex direct and indirect effects of those policy changes. And we are the only widely available economic model that does account for these DEI issues. And just some of our past work in the area of tax and fiscal policy includes work with Washington State, Alaska, New York, the NEA, Louisiana, Illinois, Texas, and Massachusetts. These are just a sampling of some of our clients, but again, we do a lot of work in the tax and fiscal policy space, and now we're adding these DEI dimensions to that analysis. So the REMI model is authoritative. We use standard metrics to evaluate public policies, and we're academically peer-reviewed, and our equations are publicly available. So we take pride in not being a black box, and we measure our success by the success of our clients. Here to give you an idea of sort of the breadth of our reach across the United States. Here are a few sample tax studies we've done. Oklahoma, looking at the fiscal effects of healthcare modernization. In Washington, we looked at an aerospace tax credit analysis. We were used to do these analyses. Also did some work in Texas and Arkansas, North Carolina, and many other states that aren't mentioned in this map. But I hope that these past study topics can give you an idea of tax policy and fiscal policy questions that also have very critical DEI impacts worth evaluating. So in conclusion, economic modeling, it matters because we need to inform policy with standard metrics and not rely on ideology or intention. Also, DEI reporting has become a requirement at the federal levels as well as in many state and local jurisdictions. So the importance of evaluating these impacts across groups and across income levels is increasingly important at all levels of government. It also is really critical to address stakeholders with evidence and to communicate that story to stakeholders using DEI impact analysis to address their specific concerns. So as I'm sure we all know, stakeholders are also increasingly interested in placing high value on understanding these DEI impacts. And finally, understanding the economic and demographic implications of policies before implementation is important to ensure that public policy serves the broad-based interests of the public as it's intended to do.